one of the things that's kind of come up in this journey, since I've talked to you about it, and I know that you've been, I think, a 4-time founder in Japan, and I wanted to talk about kind of the startup ecosystem in Japan, and then also like what that specific funding journey looks like, going from pre-seed all the way to wherever you decide to exit or IPO or whatever that ends up being. And so for you, I guess walk me through what this process has been like at Kimaru, and then also just maybe your experience in bird's eye view of the startup landscape in Japan.
Sure. So I've been in Japan starting businesses or helping, let's say, scale-ups, large-scale startups that are ready for global expansion to enter the Japanese market for 20 years now. And through that process, I've either started my own businesses, helped companies, go to market here in Japan, as well as do some very early stage investing as an angel investor, work as a consultant at private equity firms that was doing JVs for Japan market entry, and work as an advisor at some of the accelerators and incubators that help the overall startup ecosystem. 20 years ago, when I was starting businesses, I looked at businesses that I could bootstrap myself because there wasn't the, let's say, requisite ecosystem. There wasn't the necessary venture capital structure, and it certainly wasn't very open to foreign founders to be able to do the VC-backed rocket ship growth, high return type of model. But there is now. And so what's changed is over the past several years, the Japanese government has become more aware of the necessity for this. There's been more, let's say, importing of a true venture capital model that I think works, and the hybridization for the Japanese ecosystem that was required for that. And then there's been the necessary infrastructure changes that go along with that. Things like changes to the tax laws, the requirements for creating a corporation in Japan, the amount of incorporation capital that was required, that changed. I think that was in 2008. And then, leaders in the creation of that infrastructure, like James at Coral Capital, who created the J-KISS documents, which was the Japanese version of the KISS, or keep it simple, convertible note documentation, right? And his making those templates available to all founders in Japan was a really pivotal turning point, because now the average Japanese founder knows how to structure an early stage pre-seed equity round using convertible notes instead of having to look for, let's say, bank loans or something like that. Right?
Yeah, so can you walk me through, this is something that I've talked to a couple people about recently, and it's something that I get bits of, but I don't really get the full scope of what every funding round means and where to stop and where to start. And when we talked previously too, you were kind of teaching me about how that balance between investment and customer revenue, and if you could talk a little bit more about that and kind of walk me through what that process looks like. Yeah.
I'll try.
Okay, yeah, let's hear.
It's somewhat ill-defined by intention, because it's a little bit, it's like a conversation with each startup and their VCs or their early stage investors. But roughly speaking, let's say that we could define early stage investment as pre-seed. So that usually means pre-revenue. That means that there's an idea. There might be an MVP or a minimum viable product. There's maybe some traction. Maybe there are some early users. You've sold a couple of pilot projects or POCs, but you don't yet have a scalable business model. And so what you're trying to do in the early stages is find out exactly what that business model will be, and then how you can scale that up through a repeatable process. So pre-seed is usually the early exploration. The funding for that usually comes from bootstrapping, and that's usually the founders who are leveraging maybe their savings or the ability to maybe bootstrap off of consulting projects. You have to be careful not to get caught in the consulting trap, but build something that's productizable, and so it scales beyond just a service business. And then sometimes pre-seed is a mix of like early stage friend and founder investment capital. The recent, let's say, evolution or advancement in venture capital has been for convertible notes. So it's a vehicle for accepting that early stage friend and founder or maybe angel investment, but without pricing the round yet. So it's not setting a valuation on the company. It's setting a theoretical, usually a max valuation. So you've got your max cap valuation, and the investors that invest in that early stage usually get clearly defined terms for when you go to the seed round and you have an institutional investor that puts a price on the round, so that their equity essentially converts at that point. That's why they call it a convertible note, either a seed or a KISS or a J-KISS or some type of structure like that, into clearly defined equity. Now, that's often a multi-step process. So while you're in the early pre-seed, you might get an investment like we did from Alchemist by going through an accelerator program. So when we went through the Alchemist Accelerator, we got our safe terms, a max cap, a valuation on the company at that time. Then we went through the accelerator, and because we went through that program and we developed an MVP during that period, and we hit several other pivotal KPIs, our max cap valuation increased. So then we have a bridge safe round where the investors who then came during that period were investing at a higher overall theoretical valuation of the company. And then the next step is a seed round where you move to an actual priced round with an institutional accredited investor, a VC, that's setting the valuation of the company at that time. So everything up until that point was theoretical. It was well defined, but within, let's say, a range. From the seed round on, that becomes quite set. But then you can go through different, let's say, rounds or different stages, even during the seed round. You can have a bridge during the seed round, which might increase the valuation. And that's a conversation with all of your investors. As long as everybody agrees, then you may increase the overall valuation even during one round.
What are the factors that are taken into consideration when they're defining those valuations? Is it like in pre-seed, because like you mentioned, it's theoretical, is it just like product market fit, or like, and then when you're going into seed, how does that change? Like how does that valuation change?
So very roughly, and I'll speak from B2B enterprise software because
exactly.
That's my experience. It's a little bit different if you're in deep tech, which requires a lot more upfront development, or in hardware, right? Because you might have to ramp up, a factory and tooling and dyeing and all of that stuff. But let's say for software, which is for the most part the norm, I think it's still something like 80% of VC investment. Maybe not 80%. The vast majority of VC investment still goes into software, let's say that. It usually looks like pre-seed, because it's pre-revenue, is making sure that you're solving a problem that people actually have, as simple as that. And then the seed round is usually, okay, you've found the product market fit, people say that there's a problem, and they will pay for it consistently. And now they are paying for it, you're generating revenue, and they're not churning. So they're using the product and they're happy to keep using for it. That's usually seed. And that defines the process where you then can start ramping up a repeatable sales process to go and solve that problem for more people. Then you usually get to Series A. And Series A is essentially saying, we've got product market fit. People are very happy to pay for this product. Now let's go and find more categories of people who will pay for this product. So Series A is usually something like, now we can expand our geographies, or we can maybe move into adjacent verticals. We can find more people that look slightly different for whom we can solve the same problem for.
It's like a specific use case moving into maybe several specific use cases, maybe moving into multiple.
Yeah, well, sometimes that's the case. Yeah, sometimes you're solving multiple different use cases, or sometimes, like in our case, we are a platform that has multiple products. So Kimaru.ai is a decision intelligence platform, and we have modules for pricing optimization, inventory optimization, route optimization, the overall demand forecasting. And as we grow into, let's say, Series A, which in our case will probably be in 2026, we may find that there's a large demand for energy optimization. A lot of the AI that we can build out right now, a lot of these agentic workflows could be applied to reducing truck rolls, to reducing or improving the efficiency of manufacturing processes, conveyor belts, and so on, specifically for saving energy, right? So that would be a product that we could launch on the platform. And that would usually be something like a Series A expansion with more development resources to fund that. And then you get into your Series B, C, D, and so on. And usually about Series B to Series C is generally for your geographic and vertical expansion. So you've got a good enough footprint that you're very clearly solving that problem for enough people that you can now either go to other geographies around the world or over to other verticals. And then Series D, E, F, G, and so on is usually for ramping up that process so that you can become a true, stable, high-growth corporation, no longer a startup, but more moving into a corporation. And incidentally, that's the greatest lack in the Japanese VC ecosystem today, is in those Series, let's say, C and on rounds. And that's part of the evolution that we were talking about a minute ago in the overall VC world. But if we look at it from a historical standpoint, and Dr. Is it Dr.? It's Richard Katz, anyway, who wrote the book that we referred to earlier, The Contest for Japan's Economic Future. He talks about how there used to be a strong equity market alongside the debt and bond market. But in the 30s and 40s, that moved away as there was more siloization for, well, to put it in diplomatic terms, a military buildup that happened at that time. And culturally, it retained through the 50s and 60s. So a strong equity market hasn't been a part of Japan's financing from, let's say, throughout the entire post-war period. It's coming now because the Japanese government realizes that there needs to be a more balanced, let's say, three-legged stool. So instead of just debt and bonds, savings, there needs to be equity as well. The average household saver is being encouraged to move from the money that's under the mattress or in the Japan Postal Savings account into the stock market, and that would be a healthier overall ecosystem, and it would get more early stage investment. And that would solve part of the problem. Right now, there's sort of this like Python-shaped funnel when it comes to VC investment in Japan. There's not enough early stage investment. There's too much investment at seed and Series A, and then there's not enough later stage investment. And Python, I mean like Python swallowed an elephant type, funnel right now. And so what needs to happen is the mentality of VCs, which was traditionally an investment banking mentality, a very debt-focused market, needs to change more into an equity-focused mindset. And that would be, I don't want to say it has to be exactly the same as the Silicon Valley model, but it would be more similar to the Silicon Valley model. So let's say that more fluidity in the equity market means that there would be more late-stage investment, and VCs would start to shift their mindset from the relatively short-term returns that they look at right now, which is something like a 4-year return cycle. For the past 10 years or so, most Japanese VCs have looked at their startup investments being returned in something like 4 years for relatively low returns. They look for something like 80% of their portfolio to give somewhere around a 30 or 40% return, very roughly speaking. And that's almost the inverse of the Silicon Valley model, where they look for like 20% of their portfolio to give 3,000% returns. or 300% returns. But Japan is moving to more towards that equity-based, more fluid market. And what will happen is, instead of looking for short returns that force companies to IPO too early or look for an M&A exit quite early, instead of that, there will be more capital available for those Series C, D, E, and F, and so on rounds, which will open up this part of the funnel. And what will happen if companies can get to the later stage equity rounds that are required for more sustainable growth, they'll move into more stable corporations, which will then give good returns to the equity market investors, the average household, let's say, investors. And that will, of course, benefit the overall economy and the overall GDP, but it will also start to emulate the Silicon Valley model, where more people like you and I that worked in marketing, for example, or business development, or engineering, or HR, or admin, or any other function in that company will have then gone through a true startup journey and know what it looks like, and then be able to tell their friends, this is what working in a startup looks like. They'll know more aspects of the startup playbook, and that will cause the necessary cultural reform that's required in Japan right now, where the average person needs to have a friend who works at a startup and says, working at a startup is extremely intrinsically motivating because I get to do meaningful work that I believe in. It's not like punching in for lifetime employment as a corporate salaryman and all of the let's say currently non-intrinsically motivating factors that are associated with that. And we could unpack that another time maybe, but let's just say that there's a lot there that needs to change. Well, if you have more people who've been on that startup journey and know what it looks like, they know what the startup playbook is, they've seen a company get to high-level growth, self-sustainability, and a good exit, that means that they can then go and advise early-stage founders. So there's this kind of myth that serial founders are what builds a good startup ecosystem, and I don't think that's the case. I think it's everybody else plus the founders. So everybody else in that team, the marketing people, the biz dev people, the HR, the admin, everybody, legal, everybody who went on that journey that now knows what startup looks like, that can then go and advise and invest as early stage founders and investors and just supportive people. And that will solve the bottleneck that we have at the entry point to the startup ecosystem, right? So once the overall funnel starts to widen out at the exit point, you get more people who can then go and advise at the entry point, and you get a much more healthy ecosystem. And then it becomes not this like constricted pipe, but more like a flywheel.
That's nice.
And that would create a true high growth startup ecosystem in Japan.
Nice. That's amazing. Yeah. Do you feel like we're on that trajectory now? You feel like it's being built out? And so one of the other things you mentioned was that this kind of balancing act between getting investment, but then also generating revenue from your customers. And what does an ideal outcome kind of look like for a startup? Like, is it that exit? Is it that acquisition? Is it building into being self-sustainable with the investment, like the further rounds beyond C, or what? I guess this is also subject, like you were saying, it's a conversation with the startup, but yeah.
Well, it's hard to answer because it depends on your model of capitalism.
Okay.
And Japan has a different model of capitalism than, let's say, America does, which is different again than from what Europe has. I would say that Japan's version of capitalism is heavily weighted towards social responsibility. It's not so much the individual shareholders that the company looks to create a return for, it's more the stakeholders, and stakeholders include the company's employees, shareholders, and all of society. Japanese companies tend to make decisions in terms of benefiting Japan as a whole, and by extension, because it's a responsible global citizen, the world. So, and I'm kind of echoing Jesper Kohl, the Japan optimist, another great economist in this. Look up his Substack. It's a very interesting read. Or just Google, the Japan optimist. But he talks about how Japan's form of capitalism is responsible and probably an emulatable model, let's say. So why does that matter? Well, ultimately, your version of, or your model of capitalism matters because in a free market economy, that equity investment, the VC money, should be flowing to where it's best deployed. And every company reaches points where it can be self-sustainable. And so it no longer requires VC funding. So let's say in Kimaru's case, in 2 years from now, we get to a point where our ability to grow our own sales outpaces the ROI that we would get from additional, let's say, investment from VC. Well, there could be a high growth point that we reach there, and that would be a good model to have. But at some point, you have to grow again, and so you might need VC to grow past that point, or there might be some technological changes that come, or maybe some, let's say, lack of engineering resources that require another infusion of capital. The capital should only be deployed when it gets the best return. And if it doesn't get the best return in that company, it needs to be deployed somewhere else. So in a free market economy, that should be a self-solving problem, let's say. So each startup and each startup founding team needs to do the math on that and understand at which point it's necessary and responsible to take more VC money because it will allow them to better, let's say, serve the needs of society and give the ROI on that deployment of capital.
Nice. And so this kind of leads to something that I realized probably should have talked about before, but it's good because I think this will be kind of maybe a nice point to end, is when, as that funding grows, as the revenue comes in, companies are going to look to hire, grow more, and that's like where we come in mostly. And so what I kind of wanted to ask you was like, that's kind of fast approaching for you guys. And so what would you feel like is sort of the ideal job applicant or job seeker that you would be looking for? Who would you be looking to join your team, and how would they fit into Kimaru?
Well, if we can hit our sales KPIs for the next 6 months, we'll reach a point where we need people in every role that we discussed a moment ago. Basically, scaling the company to become more like a self-sustaining high-growth corporation, let's say. But the current immediate need is sales. But let's not just say sales, because I think sales is kind of an outdated term. Revenue generation. So I recently took over as CEO of Kimaru, but previous to that I was the CRO, Chief Revenue Officer. So sales and marketing reports to the CRO position. And that was structured because they're so closely interconnected these days that sales, marketing, sales, engineering, customer success, management, almost all of those functions are directly related to revenue, right? So let's say that in the short term, we definitely need more revenue generating humans. And then once we've checked that box and we can hit, let's say, self-sustainable growth based on a good GTM strategy and sales engine, revenue generation engine, then we need more engineering resources. We need more administrative people. We need HR and all of those other functions.
Nice. And from like a more of like a soft skills perspective, like what's the type of mindset that you're looking for when you're going to be making those hires in the future? And I kind of want to, what I really ask is kind of like, what does it take to work in a startup? Because you mentioned like you see that growth and you get to that level where you understand, and it's like, what are the types of people you feel like are successful in that type of environment?
Well, adaptability. The career superpower, I think, probably for the rest of our lives and maybe forever, is going to be adaptability. And I think adaptability comes from curiosity. If we look at sort of the personality characteristics there, it comes from a high level of openness to new experience, a high level of, let's say, self-direction and self-study. So we need people who are curious about this upcoming technology and able to self-direct to keep learning about the new technology. And then, let's say, people who are really motivated by solving a macroeconomic problem like supply chain, which is not a small problem. It's a $1.6 trillion problem, according to Accenture.
Yeah. Nice. I think that covers everything that I had. Let's just give people one more chance to reach out to you. So if you could just say where they can reach you and where they can learn more about the company one more time.
Sure. Well, you can connect with me on LinkedIn. So just search for Evan Burkosky. I'm the only one on the planet with this name, so pretty easy to find, that I've been able to find so far. Or Evan at Kimaru.ai.
Perfect. Awesome. Thanks so much, Evan.